rite of passage.
So I'm looking out my window to my right now in my backyard, and my favorite are the ones that are orange and red, like they get super bright.
Oh yeah, love those.
And then you got the yellows and whatnot, and then you got some of the ones like I guess the some of these trees are.
I thought you were going to say the tree name, like a maple, like the actual.
Oh, I wish I knew that. No, I need like a guide. I need a guide of what I have in my backyard.
An arborist.
But anyway, so they were talking about like what actually happens. And do you know exactly why the leaf color changes?
Something with photosynthesis.
That's part of it. So like during the summer months, right? All the leaves are green, of course. And that's because there's an active process of photosynthesis going on where the tree is absorbing the energy from the sun.
Yes.
And the sun, based on the position in the sky, is strong enough to provide that energy that the leaves need, and so therefore that's why they're so brightly green. That gives the tree the energy vibrancy and the nutrients that it needs, right? And then as the autumn season rolls in and the angle of the sun starts to get lower in the sky and we start tilting away from the sun, then the strength of the sun is less, and so the tree senses this, and what it does is it starts to protect itself by essentially taking some of the energy that are in the leaves and retreating back into the branches. And what's left, so the colors are already there, which was interesting. So all the oranges and the yellows and the oranges are in the leaf itself, but the green is there because of the energy and the photosynthesis happening throughout the summer season. And so what's left after the tree kind of protects itself are the natural colors of the leaves after that process is done. And then, the leaves start to fall to the ground, and then the end of the branch provides a protective coating around that bud to protect it during the winter. So I thought that was really interesting.
I knew you had a lot of hobbies, but I didn't realize that, earth science was one of them. Very impressed.
Trying to be a well-rounded individual.
It's incredible. And nothing goes better with fall foliage than, a pumpkin spice latte, right?
or a pumpkin beer if you're into that. Nick and I were chatting about that before, although some of them, in my opinion, have gotten just way too heavy. A little hint of pumpkin could be good.
And then, like a sip and then I'm good.
Yeah.
But yeah, it's fun and seasonal for sure. Well, greetings to all of our listeners. We are Amplified Wealths According to Plan. I am Kate Fishbein. I am here with my co-host, Tom Farrell. Thank you for joining us. And
Good to get back together again.
It's an exciting time of year. It's fall. And I think kind of with the start of the school year, maybe this kind of seems like a rudimentary topic. So kind of back to basics in a way, the one that we're going to do today. So, but it also impacts so many people, I think.
And timely, just given the nature of what we're going to talk about, which is required minimum distribution. Super exciting topic, but this is something that has a deadline, and the deadline coincides with the end of the calendar year. So when we find ourselves chatting about this is, towards the end of October. And we're talking to clients about, we call these RMDs for short, required minimum distributions. And it's something that you need to take action by December 31st.
In most cases, but we're going to go through that today. So let's start at the beginning, right? So,
yes.
What is a required minimum distribution? Essentially, they're the minimum amounts which you must withdraw from your tax-deferred retirement accounts, such as traditional IRAs and 401ks. There's some caveats there we'll talk about. And that these are annual amounts that have to come out each year after a certain age. And as Tom mentioned, that, cutoff is usually December 31st. And it's something that's, challenging for a lot of retirees because it's something that's got to happen each year. So it's not just one and done. It's each year, got to remember it. The calendar's ticking, something to keep on top of.
Absolutely. And the concept here, is what we've done is we've entered into an agreement essentially with the government, right? Everybody, typically knows about IRAs and 401ks as a way to save towards that retirement, right? Depending on where you are in your career, that could be a long way off, or it could be, a couple of years from now, could be happening right now. And one of the incentives to save for our own retirement is to get some sort of a tax deduction upfront for saving for ourselves. And so traditionally speaking, folks that put money into IRAs, you'd like to be able to deduct that contribution on your tax return, right? Same thing with 401ks. You want to put, typically pre-tax dollars into 401k. That's what we see most of the time. Although you can put in after-tax dollars via Roth 401k. But in terms of this agreement that we're talking about and why RMDs exist, is essentially, there is that upfront tax benefit for making the contribution. And then while the money is inside of these accounts, Kate, there is no tax drag, right? There's no annual taxation that you need to file on your tax return. And so, that's a big incentive. It's what helps these accounts grow over time. But at some point, part of that agreement is the government says, listen, we've allowed you to save this money. We haven't touched it while it's been inside your account. It's been growing without any taxes. Once you reach a certain age, we're going to require that you take out at least a portion of that account value and expose it to tax.
And that makes sense. You get this wonderful benefit. Essentially, these funds are kind of earmarked for retirement. So retirement comes, it's knock, knock. Let's start taking out those funds for kind of what they were intended to be. And again, as you've mentioned, you have that wonderful benefit, not only of getting that initial tax deduction potentially, but then having had the funds grow tax deferred over time, and allowing hopefully the beauty of compounding to have taken over. And these are pre-tax funds most of the time. So yeah, they've come out taxed as ordinary income. So essentially, the tax ban comes at some point.
Yeah, and it becomes part of the, if you think about cash flow in retirement, obviously one of the number one things that people think about is Social Security. And the other thing would be, once you start to learn about the rules involved in IRAs and 401ks and things like that, and that RMDs are part of that equation, then, that can be factored into annual cash flow, right? If you need to be living off the assets inside your IRA and your 401k, then distributions become part of that cash flow equation. And you can think about it in terms of, helping to fund your lifestyle.
Right. And that's what the funds were most likely intended for. So makes sense. So part of, I think, the confusion surrounding these required minimum distribution is that there's just been a lot of changes recently. We had Secure Act 1.0, and then we had Secure Act 2.0. And with both of those acts came changes. So let's break down some of what those changes were and how it affects retirement ages going forward, because I think that's where a lot of the confusion lies. And we're going to focus more on the individuals that will be impacted by RMDs in the future, as opposed to those that have already been taking required minimum distributions.
Okay.
So originally, when you and I started, long time ago in this business, right, the required minimum distribution was 70 and a half. It always seemed like a bizarre age. But that was it.
Typical Congress, though. Yeah. Nothing is exactly straightforward, right?
Right.
But you're right.
More confusing.
Starting back, for the first essentially, 2 decades of my career, the RMD age was 70 and a half. It was ingrained in our heads. How many times we had to say that? Yeah, 70 and a half, and it was bizarre and it was odd, and people, then you have to do math a half a year. It just made it more complex. But the Secure Act of 2019 raised the required minimum distribution age to 72. And of course, they did this at the end of the year, so it made things even a little bit more of a scramble, right? Come 2020, if you recall. And then came Secure Act 2.0, which then passed late in 2022. And then it raised the age starting in 2023 to 73. But then beginning in 2033, the age is going to rise again to 75 years old. Clear as mud, as they say.
Clear as absolute mud. Yes, clear as muddy mud. So what is your RMD age, Tom? What are RMD ages?
Well, so I think, if you think about the way you describe the changes that were made, it obviously led to a lot of confusion. One of the simplest ways to remember what anybody's RMD age is now moving forward, right? To your point, we're talking about, these cases moving forward, is think about the year that you were born. And so folks that are subject to RMDs starting at age 73 are the IRA owners who were born between 1951 and 1959. So if you're born in the 50s, 51 on at least, your RMD age is 73. If you're born in 1950...
And this is your actual birthday. Like I still, like to think I'm 28 every now and then. So this is your actual birthday.
Yeah, let's be real. Let's be real here. Yeah.
I want to be.
Yeah, we're talking about dealing with the IRS consequences, which we'll talk about,
facts.
At some point. But yeah, we got to be real with ourselves here. So 51 to 59, RMD age is 73. And this is part of that Secure Act 2.0 change. And then for folks that are born 1960 and thereafter, the RMD age is going to be 75. So I think that's a simpler way of thinking about it, right? We all know when we were born. And so if you just factor that in, then you can actually do the math in terms of, okay, my RMD age is going to be this or that. 73 in the 1950s from 51 on, and 75 from 1960 and thereafter.
Right. And those born in 1950 and earlier were either impacted by the Secure Act 1.0 with that little short stint of being 72, having to take the required minimum distribution, which is, that would have been for folks, 1950s, some 1949 birthdays, and then 1949 and before that were impacted by those previous rules with that, wonky 70.5 year.
And then if you remember, because it wasn't that long ago, when the pandemic happened, the IRS had that special rule that said, listen, we'll give you a pass on your RMD. And so that just added another layer of confusion. It was a nice benefit to have to, have the ability to skip a year, if you will, but that's behind us now. It's just one of the things that, has led to some of the confusion. So after so many years of being at 70.5, we've gone through so many different changes over the last, let's call it 5 years or so, that, we wanted to make sure that we're trying to, make this as simple as possible moving forward for folks as per the new Secure 2.0 Act.
Right. And I think that 2020 year was lucky too, because, everyone was it was clunky adjusting to those new rules. So
absolutely.
So now that we know what age we need to take a required minimum distribution, let's talk about the required beginning date. Because as we mentioned, there's kind of this little grace period when you have to first start taking it, but it's only given in that first year.
So it's all about the details. Like everything in life is about the details. So, and it's all about acronyms too, right? We live in a world of acronyms. So RMD is what we're talking about here today. RBD is another very important factor to consider when it comes to required minimum distributions. Required beginning date is technically April 1st of the year after an IRA owner reaches RMD age. So for example, if I turn 73 this year in 2025, if my birthday is today, right, then typically my first RMD would be due by the end of this calendar year, by December 31st, 2025. But in my very first year, and only in my very first year, I can delay when I take my first RMD. And that's up until April 1st of that year after I turn 73. So I could wait. I could take my first RMD, not by December of this year. I can wait until April 1st of 2026 to take my first RMD. And that go ahead.
You go. I was going to say, and that's April 1st, not April 15th. Because a lot of people, I think, confuse that. They say, oh, well, it's the tax deadline. No, it's not. It's April 1st. So not April 15th, just to clarify that.
Exactly. That's super important. If you're gonna choose to delay your first year RMD, you need to make sure that you're doing it within the allowed window. You don't want to put yourself in a penalty situation, which we'll talk about in a little bit here. But one of the things, and this could make sense, right? This could make sense if, for example, let's say this year I turn 73, but my income is still very high, right? And next year I'm going to be in a much lower bracket. If I do the math, it may make sense for me to take my first RMD, in the first 3 months of 2026. But if I do that, that means that my second RMD would also be due in 2026 by the end of the calendar year. So in that case, that
first year, grace
in that case, I'll have two RMDs in one calendar year. So again, this is case by case. You got to do the math. You got to figure out if that makes sense for you. Typically, what we see is it doesn't make sense. Typically, we'll talk about that required beginning date factor for the very first RMD with clients. But for the most part, in my experience, we're typically taking that first one in the year they turn 73. And then the next year, they're on that annual RMD timeline.
Right. And I really view this as a grace period, right, for that first year, that you get a little bit of wiggle room in terms of like the year end comes and you're like, oh my gosh, I was supposed to take my first required minimum distribution, because you're not in the groove yet of that kind of annual cash flow and that annual kind of checklist in your mind. So it's a little bit of extra time, but not much. And again, it does not coincide with that text deadline. It's April 1.
Right. And I'll say the custodians have been doing a better job, Kate, of keeping track of this for folks who own IRAs. They have the data in terms of date of birth. And a lot of times what you'll see on the statement is there'll be a page in there and it'll have a required minimum distribution section. And it will typically show, listen, based on the value of your account last year, because we'll talk about how to do the calculation in a little bit. Here's what your RMD calculation is supposed to be this year. So, if you're unsure, take a look at your statement and look, leaf through to see if there's a section on required minimum distributions.
And ultimately, though, the onus is on the account holder, right? So making sure that you're on top of it and keeping track of the rules, is paramount. Before we get into the penalties, I think we should talk about how does again, the custodians are a lot of times helping you with this required minimum distribution calculation, but let's discuss how that figure is calculated before we go into the penalties.
Yeah, good point. All right. So it's actually a pretty simple calculation. So the IRS publishes what they call a life expectancy table. And there's different versions out there. But for the purpose of our discussion today, we're going to stick with what's called the Uniform Lifetime Table. And this is the table used for IRA account owners who are, typically it's based on life expectancy of a married couple where your spouse is not more than 10 years younger than you.
Right, because that's a different table.
Exactly. And Kate, it should be noted that folks who are not married also use the Uniform Lifetime Table to calculate their RMD. So it's not just for married couples. So, some of the stuff can get a little complex depending on your personal situation. There is a different table if your spouse is more than 10 years younger than you. But if we're just talking about how does the calculation work? Well, you would look up this life expectancy table and that would give you what's called a divisor. And there's a divisor for each age. And so, for example, at age 73, the divisor for RMDs is 26.5. Subsequently,
Sadly, I've committed that to memory.
Exactly. At age 74, do you know what it is?
25 point something.
25.5.
Oh, okay. Close.
So it's not linear. It's not 26.5, 25.5, 24.5. It just happens to be that 73 and 74 are both 0.5. But you'll see if you look up the tables, which you can, just Google IRS Uniform Lifetime Table.
That's where I'm going to geek out for a sec. It's publication 590B in the IRS tables. So usually towards the end of that publication 590B is where you can find the lifetime expectancy factors.
There you go. So if you think about that, so what does that mean? So a lot of times we'll get clients that'll ask us, well, like, how much do I need to take out of my IRA? And the thought process is that, they think about it as a percentage. What percentage of my IRA do I need to start taking out?
I know.
So if you translate that into a percentage at age 73, you're taking out roughly 3.8% of your IRA account balance. Okay. And what IRA account balance are we using? We're using the IRA account balance as of December 31st of the year prior. So if I'm 73 this year and I'm taking my RMD, I look up the value of my IRA as of December 31st, 2024. And
so
let's
essentially
say
that year-end statement.
Exactly.
And you're using that balance without accrued interest, usually.
So you look up that balance, and just to make this simple, let's assume there's $1 million IRA and my divisor is 26.5. That translates to an RMD, a required minimum distribution of $39,215. And if you do the math on what percentage of that is, that's 3.8% of $1 million IRA. Just to give you some more context, a person age 80, their divisor is 20.2. So the older you get, the divisor gets smaller and smaller. Okay. So $1 million IRA, if I'm age 80, my RMD would be $49,504. So about $10,000 more than somebody age 73.
Right. So a bigger percentage. So even though, because remember, we're going back to numerator denominator stuff. And when that denominator gets smaller, it's actually a bigger percentage of the account that's required to be taken out.
Exactly. So at age 80, the percentage that comes out is almost 5%.
Right. So in this, doing the equation, the numerator or the number up top is going to be that 1231 of the previous year market value, and the denominator is going to be that life expectancy factor from that publication 590B that you use to come up with that required minimum distribution figure. And that number changes each year because of exactly what you said. The market value is going to change and your denominator is going to change.
Right. And I would just say, all we're talking about here is the minimum. You can always take more, right? Again, I would say this is, if you own an IRA, that's your money, right? You're always allowed to take more. If you choose to, just know that if you do that, that means your tax bill would typically be higher, right? So we're talking about the minimum that needs to come out. And just to give, I was going to give one more example, Kate.
Oh, good.
So just real quick on if your spouse happens to be more than 10 years younger than you, there's a different table. And the reason there's a different table is because now there's a bigger discrepancy between ages of spouses, right? So they want to factor that in. And so you would think that hopefully that means that my RMD would be a little lower. And the answer is yes. So for the same, I pulled an example. For somebody who's 74, in my example before, their RMD was 39,215, right? And that's using the uniform lifetime table. If somebody was 74 and their spouse was, for example, 62, more than 10 years younger, they would use the joint life and expectancy table, and their divisor would be 27, meaning their RMD would be $37,000. So a little bit less than the uniform lifetime table.
Right. And just to talk to that point you made earlier where, hey, these are your assets, you can take more, but you also want to make sure that, you're viewing these assets to continue to support your longer term needs as well. So making sure that you're kind of hitting that sweet spot of, yes, taking the minimum. And if you are going to take more than the required minimum distribution, just making sure that you're not distributing more than what the account can handle for your longer term needs as well. Because you don't want to be distributing too much where you're depleting the account's ability to grow for your future needs.
That's a good point. And and it's also one of the things that comes up where, if somebody has the bulk of their liquid investment assets in IRAs and 401ks, you have to factor in the tax impact. So you gotta gross up the distribution to account for the tax liability. We'll talk a little bit more about this. So that the net number that hits your bank account, right, is there for you to fund your normal cash flow needs. So that's just an important factor to keep in mind when it comes to what bucket am I sourcing my cash flow from, right? And if you're in RMD age, then yeah, you got to deal with the RMD and you got to factor that into a distribution and account for the taxes for folks that don't have different types of buckets. And by that I mean, a large after-tax investment account, right, that you could use to supplement what you need to take out of your IRA or 401k. It's a different type of a calculation.
And the other thing I want to point out too, that's a great point. The other thing just to highlight, and I'm sure we'll mention this again, kind of in our summing it up, but these rules are not for inherited IRAs. Remember, those inherited IRA rules follow, a different set of rules to play by. So just to point that out, that these are not the inherited IRA RMD rules. They follow a little bit different of a pattern.
Good point. So what happens if you miss your RMD, or let's say you don't take out enough of your RMD?
Well, Tom, when we first started, it was scary. It was very scary. And there was this, that used to be 50% of the RMD amount. So in your example where someone would have, a $37,000, RMD, that's going to be, over $18,000 in a penalty for not having taken the required minimum distribution.
Pretty steep. Yeah.
Oh my gosh, that is so painful. So now, thanks to the Secure Act 2.0, those penalties have been reduced to 25%. And if you resolve the matter in a timely fashion, it can be lowered to 10%. And I believe that timely fashion is, a 2-year window, but really resolving things as quickly as you can, and working with your accountant to make sure that you're doing things properly.
Yeah. Our advice in that situation would be, obviously you don't want to be in that situation, but if you are, contact your tax advisor. Remedy the distribution as soon as possible. Make note of it, right? Your tax advisor would likely have some advice in terms of, what they would do. They might add an addendum or letter to the IRS explaining the problem, what was done to rectify it. Here's the proof, here's the distribution, and then hopefully that would lead to a smaller penalty.
Some kind of an I'm sorry along with that.
Right. I took care of it. I missed the deadline, but nonetheless, penalties would be involved, which is where you don't want to be.
Nope. Nobody wants to have to pay more than they already have to. So let's talk a little about those aggregation rules, because I think those can be a little tricky because it depends on the type of account you have as well and how those RMDs can be handled.
Yeah, and it's not uncommon that folks have multiple IRAs, let's say at different institutions, right? They started saving in one and then they moved and, let's say they started saving in another IRA at a different institution, then they rolled over a 401k at some point, and next thing you know, they have maybe 3 or 4 or more different retirement accounts, and now they need to start taking their RMD.
Right. So let's say you have an IRA at one custodian and an IRA at another. You calculate the required minimum distribution. Let's say it's, a total of $10,000 between both accounts, both, let's say, traditional IRA accounts. You could take $8,000 from one IRA and $2,000 from the other, as long as you're fulfilling that $10,000 that's required for the year. It can be taken in an uneven amount from each of those IRA accounts, as long as it's being distributed. And that goes across SEP and simple IRAs as well.
The other way to think about that too, well, the other opportunity would be you could just add up the total amount of RMDs for all of your IRAs, and you can take the RMD amount out of just one.
Yes.
So if you want to simplify, okay, listen, I got 4 IRAs. They add up to $1 million. And so, my RMD, back to my example, is going to be, $39,000. I'll just take it out of this one IRA, right? That'll satisfy my RMDs for all 4.
You're making it very easy. You make it sound so easy. Right. As long as that amount that needs to come out is coming out of at least one of those IRAs.
Right.
And again, that's only traditional IRAs, SEP IRAs, and simple IRAs does that rule apply to. The one thing that I think can trip some individuals up is, when you have an IRA and your spouse has an IRA, each of those IRAs are going to have their separate required minimum distributions. You cannot apply that aggregation rule between your spouse's IRA and your IRA. Each spouse has to take their own RMD out of their IRA accounts. Just because your husband takes, enough for you and him doesn't mean that you fulfilled that requirement. Remember, it's an individual account, right? So making sure that you're both taking your required minimum distribution. And then again, we mentioned earlier, but that inherited IRA rule, that does not apply here in that aggregation rule. Sorry, that's got to be calculated and distributed separately. And again, by those different inherited IRA rules.
And the other thing I would point out there is completely different set of rules, as you mentioned, Kate. And, and again, if you inherit an IRA, let's say one from your father and one from your mother, you got to take separate RMDs from each of those inherited IRAs as well.
Can't. That's a great point.
So, a lot of this can, I guess it can sound complicated, but, if you look at the facts of the case, identify what kind of IRA or let's say, what kind of retirement accounts do I have, right? What nature are they? Is it an IRA, 401k, inherited IRA? Is it a Roth, right? Then what are the rules that are applied to each one of those? And then, facts of the case would be, okay, listen, I have 3 IRAs, then I need to follow this set of rules. If I have 3 IRAs and 1 inherited IRA, I got to follow these set of rules. And so it can sound confusing, but if you lay out the facts of the case and then proceed accordingly, that's how you don't trip yourself up.
That's great advice. And then just to further complicate things, 401ks, 403bs, 457bs, there are different rules there as well. So essentially, there's no aggregation allowed across the plans. So each RMD must be calculated and then withdrawn individually. The one exception there is with 403bs, where you can consider potentially that aggregation. And then, remember, one of the perks of having a Roth IRA is that there are no required minimum distributions if you're the original account holder. For inherited Roth IRAs, that's another story. But for the original account holder who has a Roth IRA, there are no required minimum distributions. And now with the Secure Act 2.0, even Roth 401ks, that regulation where RMDs used to be required for Roth 401ks has now been eliminated thanks to the Secure Act 2.0.
Which was crazy, by the way. I mean, money in a Roth type of an account, in this particular example that you're talking about, is a Roth 401k. Yes, you used to be subject to making distributions. Now, those distributions weren't taxed, but and you can say, oh, okay, great. That sounds fine, right? There's no tax on it. But the problem is essentially what they were making you do is take money out of the Roth bubble where there's no taxes whatsoever, right? On all the growth that happens inside that account, any trades that you make, things like that. And they made you expose it to the world where, everything is taxed, right? Which was not a great situation. And you had to really pay attention. Listen, if I have Roth 401k assets and I don't want them to be subject to distributions, then I should roll that to a Roth IRA, in which case, okay, I don't need to do anything with that. I can keep it in the bubble and it's all good. Right. So this was a, in my opinion, a nice benefit. It makes more sense.
It is, and it makes it so much easier for individuals. So a great benefit.
And then real quick, Kate, just back to your point about the 401k part of it. Mm-hmm. I just wanted to make sure that we're clear on that so for example, if somebody has one IRA account and they have one 401k account and they're subject to RMDs, mm-hmm. they cannot aggregate those two because they're two different types of retirement account. They got to take their IRA RMD from the IRA. They got to take the 401k IRA RMD from the 401k, and then they'd be fine. Could somebody consolidate those accounts? Yes, they could. Right? They could roll over if they wanted to. 401k
into an IRA, but depending on, if, again, then you got to consider if you're still working, if you're allowed to, do that rollover yet.
Right. Lots of different individual circumstances there. But, that's one question we get from folks is, what should I be doing with it? And that's a topic for another day, but just wanted to be clear about keeping those accounts separate when it comes to the RMD calculation.
Great point. So let's start to synthesize some of this and maybe bring in some key points for our listeners. I think the one big thing, that individuals don't always recognize is that as we started our conversation, we were describing, these are a lot of times these pre-tax traditional IRAs are funded with pre-tax dollars. They have this wonderful benefit of growing tax deferred, for a while, and then you've got to start taking the required minimum distributions depending on when you were born at different ages. And when you have to take, you start taking these distributions, whatever you're taking out comes out taxed as ordinary income. And now given there could be the situation where you have after-tax dollars in a traditional IRA, in which case then you might have a different set of, then that pro rata rule might come into play. Right. But if you're having pre-tax dollars in an IRA coming out as a distribution, it's taxed as ordinary income. So the first conversation that a lot of times individuals want to have is with their accountant. And why is that? Oftentimes custodians will allow you to have taxes withheld for both federal and for state taxes. So making sure that you're considering this as part of your income stream for the year. If you're not having taxes withheld, having that conversation about estimated taxes with your accountant and making sure that that's being factored into your tax landscape.
What's the alternative? A lot of times...
Not paying taxes?
Yeah, well, a lot of times custodians will... Well, but that's what happens. A lot of times custodians will say, listen, you got this RMD, right? And it's going to be $20,000. and you might check the form, and say, okay, great, send me my $20,000. And if you don't elect any tax withholding, they'll send you the $20,000, and you haven't addressed the tax impact of that. To your point, right?
Yes.
That's a big deal, and it can be overlooked if you're not paying attention to it. And so, when we're talking about RMDs and making these taxable distributions out of retirement accounts, IRA owners can put themselves in the driver's seat when it comes to making the decision about how much to withhold for taxes. Think about it as, I work for a company, I get paid a salary, and I get to fill out, my W-4 to elect how much withholding I want to have withheld from my paychecks, right? There is some control we have in terms of how much withholding that we elect to have. That comes out every payroll period, right? Because the IRS needs to be paid throughout the taxable year, or else you might put yourself in a penalty situation. When it comes to these, go ahead.
I always make the joke that I don't like surprises. I don't even like surprises on my birthday. And my least favorite surprise is the April 15th surprise. And I think a lot of clients feel that way too.
Amen to that, right? That's the worst surprise to have.
Yes.
Universally, I think we could both agree to that. And so, I would say whenever it comes to the decisions that we're talking about here, for our RMDs, is we can be in control of how much tax withholding occurs at the point of distribution. So if I choose to take my RMD, let's say, mid-year, I raise my hand and I say, you know what, I want to take it now. It's July. I take my $20,000. I elect to have 22% withheld for federal taxes, and I elect another 5% for state income tax, depending on where I live, right? So, therefore, at that point of distribution, I've already taken care of the withholding piece for taxes, as opposed to waiting, Kate, to your point, until not doing anything, no withholding. And then you start doing your taxes come next spring, and you realize that, based on all the other taxable income I have, I'm under withheld. I'm going to now owe taxes, and there could be a big surprise there.
Right. At a bare minimum, right, if you're not going to withhold, make sure you're looping your accountant in. So hopefully that they are factoring that into your estimated payments that you're making throughout the year. So you're at least making that safe harbor, considering that additional income from the required minimum distribution. So let's talk about additional impacts of just having extraordinary income as a result of these required minimum distributions coming out. Right. So the obvious, right, is that more income equals, hey, maybe you get into that next tax bracket, right? Maybe you're pushed into that next tier of higher tax rate on that additional income. So that's a possible impact. It could also increase your IRMA, or your income. Make sure I get this right. Income related monthly
adjustment amount. Isn't that awful? It's awful.
It doesn't flow off the tongue. IRMA.
Yeah, it doesn't.
Especially what you have to pay for Medicare each month, right? So when your income's higher, that could increase your monthly Medicare expenses that you have to pay into the system. And then it could increase your AGI, your adjusted gross income, and your modified adjusted income, which could impact the amount of Social Security that could be taxed. It could also impact certain tax deductions that are income capped. So new ones, right, would be that senior tax deduction, the SALT income cap. So those kinds of things, medical expenses, right, have to be over a certain floor.
Exactly.
Certain things like that will be impacted by that higher income.
Yeah, and let's not forget that Congress passed the One Big Beautiful Bill Act this past July, and that comes along with a lot of updates to the tax code. And people that are taking RMDs, that taxable income will flow through to their particular tax return in a certain way, and it'll affect each taxpayer differently. So you got to look at your own situation and determine how this is going to impact things like, am I going to use the standard deduction, or am I eligible to do itemized deductions this year? That's going to be a case-by-case basis. So, planning now for, here's how much my RMDs should be for this year, and I got to factor that into all the rest of my taxable income and see where the dust settles at the end of the tax year.
Right. And for those that I would say are already charitably inclined, one option to kind of offset some of this income, or is this qualified charitable distribution, which for 2025 is capped at $108,000. You must be 70 and a half or older to take advantage of this this qualified charitable distribution, aka QCD. A lot of times, it usually makes sense if you have to take the required minimum distribution. A lot of times we don't see individuals at 70 and a half already taking advantage of it. But if you're already taking that required minimum distribution, are charitably inclined, this might be an option. Let's talk about the mechanics of that real quick. So it's essentially a distribution that's coming from your IRA. You work with the custodian. It's sent directly to the charity. You're getting the ability to not have that income count towards your taxable income, or that contribution not count towards your income, and yet you're able to make that contribution to the charity. So you're lowering that taxable income in the year by the amount of that qualified charitable distribution. So makes sense for those.
I think this is a fantastic feature. It's one of the elements of charitable giving where if you're of age, to your point, if you're older than 70 and a half years old and you're already charitably inclined, I would seriously consider how this would impact, your personal situation because of the benefits you just outlined, Kate. This could be a nice, powerful way to give to charity, satisfy your RMD, right? Reduce your taxable income because that income is essentially invisible, right? Because you're not taking it yourself. It's going to a qualified charitable recipient. And so I think this is going to be, and if you think about how the OB3, the One Big Beautiful Bill Act, a lot of people are trying to figure out ways to describe this. Is it OBA, ABA, or OB3? I've been hearing folks talk about OB3.
I like
and
OB3,
I think I like that a lot. It reminds me of Star Wars. But there's a bunch of different rules that start to kick in 2026 that limit charitable contributions in a couple different ways or so. So QCDs should be something that I think every IRA owner who is already charitably inclined should consider and think about.
Yeah, and especially if you're already faced with that required minimum distribution or charitably inclined, sometimes the QCD can even make more sense than gifting low-cost stock from a tax perspective, because there's a little bit more of a tax oomph there. The one thing too that I think is interesting, I've had more inquiries about this lately, is taking required minimum distributions in kind, because this is something that individuals are able to do. You can take your required minimum distribution in kind, or
what does that mean, Kate?
Distribution. So that would be taking stock and taking it from the IRA and sending it to a individual brokerage account, distributing at least at a minimum the market value. And I think that's the tricky part, right? Is you have the market value of that underlying security is going to fluctuate. So maybe you can't get to the penny of making your required minimum distribution, but you can essentially satisfy the required minimum distribution with an in-kind transfer of stock.
So if I have 100 shares of Apple in my IRA, I could choose to move the 100 shares of Apple from my IRA to my brokerage account. And the market value of those 100 shares on the day of distribution would satisfy my RMD.
Distribution.
Exactly. Mm-hmm. I think that's folks should know about that, number one. And number two, that could be, could be a viable option. Let's say let's say you're not spending your RMD.
I was just going to say, if you don't need the cash and you want to stay invested, that could make sense for someone. Because remember, you're taking, you're taking an asset that had been tax deferred, moving it into an individual account. The cost basis is my understanding is that it is, the market value as of the data transfer in the individual account. So you're not getting any added benefit of, cost basis. The cost basis, it's almost like you purchase the stock in that individual brokerage account as of the date of transfer, where you moved those, shares in kind out of the IRA into the non-IRA individual account.
Yeah, I think that's a great feature. Obviously cost basis doesn't matter in IRAs, but if you think
Doesn't matter
about
in IRAs.
right, but if you think about some of these tech stocks that folks really love, right? And if you bought shares of some of these tech stocks years ago and you held on to it, typically your basis is very low. And if you had it in a brokerage account, you have a pretty big embedded unrealized capital gain that you may not want to realize, right? Because that's going to cause more taxable income. But if you like your shares of XYZ tech stock, and I'm just using tech stocks in this example, and you move those shares in kind to your brokerage account, now your basis is updated to the market value on the data transfer. And
just on those shares. Yep,
just on those particular shares. And, and so now you basically start fresh, right? Now that's in a brokerage account. And if you happen to be in a situation where you need some cash flow, let's say beyond the RMD, and now you're looking at your brokerage account, let's say everything else has a large embedded gain, that becomes an option where if I have to liquidate something, maybe that becomes a target that I use.
I think it really makes sense for individuals who just want to stay invested. And I would say, to your point, a lot of these names which have been, little darlings and have done exceptionally well for individuals, continuing to watch your overall concentrations as well, right? If you want to stay invested, this could be an option, but making sure you're monitoring your overall asset allocation and making sure everything's still in, good spot.
Yeah, good point. And I would say it's not all or nothing. You can do it all in cash, right? You could also just do it all in kind. But you can also do a combination of cash and transferring shares in kind. And sometimes that'll work, to your point, Kate, market value changes throughout the day. And if you're moving something that has a value that you can't quite, pinpoint based on when the transfer occurs, you might be above the RMD amount, or you might be below, and you could use some cash to, top it off to the exact RMD amount. You could also use cash to handle the withholding portion.
I was just going to mention exactly, that you don't forget the withholdings. And if you are going to do the withholdings, if you're doing it in kind, you've got to make sure you've got that cash available for the withholdings.
So maybe it's not 100 shares. Exactly. Maybe it's not 100 shares of Apple, but it's 75 shares of Apple. Right. And then the difference is cash, and I use that for my withholding. So there's a few different ways to slice this up depending on your personal situation. But, it's an option we wanted to make sure we chatted about today.
Sure. And then, the timing, as we mentioned, that initial required beginning date is, April 1st, not April 15th of the following year, of which you turn RMD age. But then just keeping in mind that, you'd have 2 taxable distributions. If you did take advantage of that grace period and wait until the second year, that you've got 2 taxable distributions coming out. So just making sure that you're watching your other cash flows and income flows and working with your accountant on that timing of that first and subsequent RMDs. One thing to mention, Tom, I know you know the answer to this. If you're taking a Roth conversion, does it count towards your required minimum distribution?
No. So you have to satisfy your RMD first.
I knew you'd get that right.
Thank you. The softballs are appreciated.
It was a slow pitch. It was a soft, slow pitch.
Sometimes you get those moon pitches that they look
those
nice and easy to hit.
Hard.
They are, yeah.
Harder because
I'll admit I've swung and missed on a couple of those before. Not proud of it, but it happens. So, you just need to make sure that you understand the rules there. You got to satisfy that RMD. And, if you think about Roth conversions, a lot of times, and we've covered this in previous episodes, Kate, right? We've done a lot of discussions on Roth conversions and all the different opportunities and the rules you got to follow and things like that. But, just if we want to create like a typical example, right? Let's say somebody retires at 65 and let's say their RMD age is 73. They got an 8-year window where, typically speaking, their income now is probably less than what it was when they were working. So you got this window of opportunity to do Roth conversions, right? If that's something that makes sense for your situation. Income is low. I can choose to make, distributions out voluntarily from my IRA and move that into a Roth IRA. But then when you get to RMD age, now you got to factor in the income associated with your RMD as it gets factored into total taxable income for that particular year. And if Roth conversions can still make sense, right? So you got to factor that income in addition to everything else.
Right. And one thing that Roth conversions stand to do is that they do help to kind of lower potentially required minimum distributions when you have to start taking them, if you've taken them before required minimum distributions. So we have a podcast on that. considerations for when you might do a Roth conversion and how it might impact future taxable required minimum distributions. And then, as mentioned, that inherited IRA follows, it goes to a different drummer, right? So different rules. And we do have a previous podcast on the inherited IRA rules as well that we invite you to check out.
Absolutely. Please listen. And then here's one that's really interesting. What, I just cut you off. What did you just say? I'm sorry.
I was letting you take that one.
Okay. I was going to say, here's one that's really interesting. And it applies to 401ks while you're still working. If I'm still working and I'm, let's say, age 73, am I still required to take a minimum distribution from my 401k?
It depends.
Because it feels like it's not fair. Why should I have to take an RMD if I'm still working?
Well, Tom, you definitely have to take an RMD from your IRA, but not necessarily your 401k, depending on your ownership in the company.
Right. So, if you are a majority owner, and it actually doesn't need to be a majority owner, it's really, right, as long as you're not a 5% owner or more of the business and you're still working, the IRS cuts you a break and you're not required to make a minimum distribution if you're of RMD age and you're still working from your 401k, which is a nice benefit. But to your point, Kate, doesn't apply to IRAs that I have elsewhere. I still got to take care of RMDs there. So when would my RMD kick in if I decided to retire?
The year after you retire.
Exactly. So, you just kind of treat that retirement year as your new, retirement year, your new RMD age for that 401k. And so you're allowed to delay it until April 1st of the year following the year in which you retire. And, as far as I know, in terms of the IRS and the underlying rule here, do you have to be working a minimum number of hours and things like that? There's, from what I've seen, there's been no final guidance or anything like that or any details. As long as you're working, you're receiving, employment income from that employer, you're not a 5% or more owner, you can delay your 401k. But then once you do hang up your spikes, so to speak, that would trigger the event that would start the clock on when my RMD would be due for that particular 401k.
And if you rolled that 401k into an IRA, once it's in that IRA vessel, even if you're working, that's when you're going to be subject to required minimum distributions.
Right. Yeah. So you got to pay attention to the details there.
That's right. Well, Tom, thank you so much. I think this is I know it kind of seems like a back to basics type of episode, but this comes up a lot, and pre-tax IRAs are probably one of the most widely held vessels. So knowing these rules, how they work, how they might impact you, I think is so important. So I'm so grateful.
Yeah, I think this touches a lot of savers out there, a lot of investors. It's just one of those accounts that's so commonplace. And so, it pays to make sure that we know how the rules work. And, we went through how the calculation is made, which is not, a wild and crazy calculation. You just need to be aware of how it applies to your situation.
Great. Well, hey, you want to send us off? Give us a good one, Tom.
Thanks so much for spending some time with us today. Please remember to like and subscribe. Amplified Wealth according to plan. The more feedback we get, the better that we can be for our listeners. And enjoy that fall foliage.
Thanks so much. Thanks for joining.